Imagine handing $10,000 to three different friends and checking back 365 days later. Multiple financial studies show that between 70 to 90% of retail day traders actually lose money over a one-year time frame. Meanwhile, parking that cash in a boring index fund could bring massive returns. In fact, it surged over 24% in 2023. So, does playing it safe always beat high-speed gambling? Hey friends, Hazel here. Today, we are putting three completely different money strategies to the ultimate one-year test. One friend buys the stock market. Another simply holds Bitcoin. The last one goes absolutely crazy trading leveraged crypto futures. Which strategy built a massive fortune, and which one triggered a total financial meltdown? Let us find out who really won this $10,000 race. 1. The SP 500 Slow Burn. Our first friend takes their $10,000, logs into a brokerage app, and buys a standard S&P 500 index fund. Total time spent? About 5 minutes. Total stress level? Absolute zero. They are not analyzing complex charts, reading midnight earnings reports, or panicking when the market dips. They simply buy a tiny slice of the 500 largest companies in the United States and walk away. Historically, this extremely boring strategy returns about 10% annually on average. But what makes it truly powerful is how incredibly cheap it is to hold. These passive funds charge incredibly low expense ratios, often around 0.03%. That means for their entire $10,000 investment, our friend pays roughly $3 a year in management fees. The rest of their money just stays planted in the soil, quietly compounding in the background. While social media screams about the next big tech breakout, this friend completely ignores the noise. They are out walking their dog, grabbing iced lattes, and actually enjoying their weekends. They understand a fundamental truth of wealth building: time in the market historically beats timing the market. Actively jumping in and out of trades often means missing the absolute best market days, which destroys long-term returns. Fast forward exactly 1 year later. Our passive investor finally opens their brokerage app. Because they completely avoided the emotional roller coaster of daily trading and let the economy do the heavy lifting, their balance is sitting at a beautiful profit. No sweat, no tears, just effortless cold hard cash earned entirely while sleeping. But what about our second friend, who decided traditional index funds were simply too slow? 2. Holding Bitcoin spot. Our second friend thinks a 10% annual return is strictly for grandpas. They want life-changing wealth right now, so they take their entire $10,000 stack and buy pure Bitcoin. But they make one incredibly smart choice right from the start. They are buying strictly on the spot market. In the crypto world, buying spot is the financial equivalent of paying straight cash for a car instead of taking out a massive loan. When you buy spot, you actually own the digital coins outright in your own wallet. There is zero borrowed money involved. This means absolutely nobody can force you to sell your position if the price temporarily crashes. And when dealing with digital assets, brutal temporary crashes are a guaranteed feature, not a bug. While our first friend, holding index funds, was sleeping peacefully, this second friend was aging a full decade in just 12 months. Holding pure Bitcoin is exactly like strapping yourself into a chaotic roller coaster in the pitch-black dark. 1 week, the market is flying high. The next week, a sudden panic sells off 30% of the value. Imagine waking up, checking your phone, and watching your hard-earned $10,000 aggressively shrink down to $7,000 overnight. Their heart drops. Mainstream news is aggressively screaming that crypto is completely dead. The anxiety is so intense they can barely finish their morning coffee. But here is where the absolute magic of the spot market kicks in. Because they used zero leverage, they cannot be liquidated. Their account is completely safe. They do not owe any giant exchange extra money. They simply have to close the app, take a deep breath, and rely on pure diamond hands to survive the nausea. And that brutal, agonizing patience eventually pays off in a historic, earth-shattering way. Back in mid-2023, Bitcoin was quietly hanging around the $30,000 mark. It was boring, sideways action. But then, whispers of major Wall Street exchange-traded funds getting approved started swirling across the internet. The moment those massive funds finally got the official green light from regulators, institutional money aggressively flooded the market. The price absolutely exploded. By early 2024, Bitcoin violently smashed past $73,000, making international headlines. Those massive 30% dips our friends suffered through earlier were completely erased in a giant tsunami of green daily candles. Fast forward to the end of our exact 1-year timeline. This friend checks their final balance, and they did not just casually beat the traditional stock market. They completely obliterated it. Their original $10,000 has much more than doubled. It was a chaotic, sleep-depriving, anxiety-inducing nightmare of a year, but the raw profit is completely undeniable. Survival in this insanely volatile digital asset market came down to one single, critical decision: having zero leverage. They owned the underlying asset outright, so they could easily afford to simply wait out the terrifying storms. But what about our third and final friend? They looked at that massive 100% gain and actually scoffed in pure disgust. Why endure those terrifying price swings just to double your money? If you know the price is going to move, why not borrow money and multiply your profits by 100? Surely, absolutely nothing could possibly go wrong with that flawless, bulletproof logic, right? Let's see how that risky strategy played out. 3. The futures trading trap. Our third friend looks at that doubled Bitcoin portfolio and just shakes their head. Why wait a whole agonizing year to double your money when you could make $1 million by next week? So, they take their $10,000, open a crypto futures account, and discover the terrifying magic button known as leverage. Leverage is essentially borrowing money from a crypto exchange to artificially inflate the size of your trade. Imagine walking into a high-stakes casino with $10,000, but the house casually hands you $1 million in chips to play with. Sounds incredibly generous, right? But there is a massive catch. The exchange is not your friend, and they are definitely not running a charity. They will lend you the money, but the absolute second your trade starts losing enough to eat into your original $10,000 deposit, they will forcefully step in and seize everything. The trap usually begins with a small taste of victory. During the first few weeks, the market is gently trending upwards. Our friend places a modest trade with just 10 times leverage. The price moves up to percent, and boom, they instantly lock in a 20% gain. They make to $1,000 while waiting for their morning coffee. This early success is actually the worst thing that could possibly happen to them. It builds a dangerous illusion of control. They start believing that their lucky guesses are actually profound analytical skills. They stop seeing the very real risk of ruin and only focus on the massive potential payouts. So, they decide to scale up. Major crypto exchanges offer up to 100 times leverage on futures. That means a tiny $10,000 deposit can command a massive $1 million position. At this point, they are not investing anymore. They are playing a high-speed video game with their actual life savings. Let's look at the brutal math of maximum leverage. If they buy $1 million worth of Bitcoin and the price goes up just 1%, they make $10,000 profit. They just doubled their entire account in 20 minutes. Dopamine completely floods their brain. They start browsing luxury real estate online and pricing out matching sports cars. But leverage is an incredibly ruthless, double-edged sword. The math works exactly the same way in reverse, and the market is completely unforgiving. If you are trading with 100 times leverage, a mere 1% price move against you can trigger total account liquidation. A 1% dip is not a historical market crash. That is literally just a normal Tuesday morning in the crypto space. Fast forward a few months into our 1-year experiment. The stress is compounding. Our third friend is staring at glowing charts at 3 in the morning, eyes bloodshot, fueled entirely by anxiety and energy drinks. They decide to go all in, betting their entire stack that the market will bounce. Then, it happens. A sudden flash crash. Nobody knows exactly why. Maybe a massive institutional holder dumped their coins, or a rumor spread on social media. Out of absolutely nowhere, the market violently drops 3% in a matter of seconds. A giant, terrifying red candle paints the screen. Our friend desperately tries to wire more money from their bank to keep the trade alive, but it is way too late. The automated liquidation engine at the exchange doesn't feel pity, and it certainly doesn't wait for a phone call. It ruthlessly market sells their entire position to protect its own borrowed funds. A cold, automated email pings on their phone. Margin call. Liquidation successful. Final account balance, exactly $0. It's all completely gone. Not a temporary paper loss that might recover in a few years, but permanent, irreversible capital destruction. While the slow index fund investor was sleeping peacefully and the spot holder was surviving the swings, our futures trader blew up their entire financial life in under 60 seconds. The alluring promise of getting rich quick blinded them to the brutal mathematical reality of derivatives. They learned the hardest financial lesson possible. When you treat the global financial markets like a casino, the house almost always wins. 4. The final wallet balances. Let us look at the final scoreboards on day 365. 3 identical $10,000 starting balances, 3 radically different financial destinies. First, the steady index fund investor. They log into their boring brokerage account, sip their morning tea, and smile at a solid balance of $12,400. They did not buy a flashy supercar, but they also did not lose a single night of sleep. By choosing funds with incredibly low expense ratios, often around 0.03%, they kept nearly every single penny of their passive gains. They are living proof that quiet time in the market consistently beats desperately trying to time the market. Then, we have the Bitcoin spot holder. They cautiously open their digital wallet and stare at a massive balance, well over $20,000. They are officially the absolute wealthiest of the three, securing the undisputed crown for the highest return. They won the money game, but at what cost? Their hair might be a little grayer now. They spent an entire year surviving terrifying weekend flash crashes, regulatory scares, and wild social media rumors. They definitely got rich, but they paid a heavy, invisible tax in pure psychological stress. Finally, our leveraged futures trader. Their account balance is a cold, hard, permanent zero. They chased the alluring illusion of overnight wealth and ended up with nothing but a painful financial lesson. They tried to outsmart a highly sophisticated global machine, and the machine mercilessly crushed them. So, who is the actual winner of this one-year experiment? If we strictly measure dollars, the crypto spot holder takes the trophy. But if we factor in mental health and sustainability, the slow and steady stock investor is the true champion. The stock market historically returns about 10% annually precisely because real, fundamentally sound business growth takes time. Investing should never feel like a high-stakes horror movie. If your portfolio keeps you awake at 3 in the morning, you are not investing, you are just gambling. Which of these 3 friends are you? Let me know in the comments down below. If you enjoyed this financial reality check, hit that like button and make sure to subscribe for more wealth building secrets. See you in the next one.